Good morning, everybody. Welcome to the Lock in Your Success Options Trading for Income Weekly Update for August 31st, 2015. Before we get going, we would like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk of loss in trading options is substantial, and be aware of all those risks prior to placing any trades. And also note that we are using hypothetical computer simulated performance results in the presentation that are believed to be as accurately represented as possible. However, live results may vary. If you're watching this on YouTube or some other venue, come on over to our website, check out our mailing list, get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for this free weekly webinar. Also check out our programs. We have the super simple spread trades, the M3, the Bearish Butterfly, the Locke, the M21, and our APM squared program. And we also have a lot of things under development, including a trading triangle book and online program. And then we have a lot of other things coming out as well that I'm putting together. So cool stuff. Keep up to date. Also, if you want to join me on Monday mornings, we have a live trade review for a $1.25 million M3 style trade. And we have a question and answering session. We just kind of go over what happened and so forth. It's kind of a neat thing. So if you'd like to join that, just join the Options Tribe at this link down here. Also, if you have not yet if you're on the list for the Hawaii Challenge and you have not yet put in your results numbers, please do so as soon as possible. For those who are not putting numbers in, we are going to delete you from the list. So, obviously August is done. So, and if September's done, I suppose you could do that as well. So please do that. And of course, here is my contact information. All right, so let's take a look at what's going on in the market. So last week, we were kind of in the middle of a market crash on Monday morning. We had the futures were down a lot. The market opened, sold off like crazy, especially the Dow. The Dow sell-off was really in a free fall for a little while there. And, we had a lot of messages coming in at me and stuff, so I was doing stuff a little quickly, and I apologize for that. Much more calmness this morning, so that's great. As far as where the markets are likely to go, I was expecting a retrace to here on the Russell with the bounce. Now that we've broken above that, and we're broken above even our downtrend channel here, yeah, it's likely we're going to 1190. If we take a look at some of the other indices here, like the SPX, again, we broke up over at least what I saw as the primary resistance area. There is an argument I could make for it being where it is now, up in here. And we may see a turnover, but the futures are down today. If we come down, we're likely to maybe retest this 1970 level, probably continue higher here. I don't think we're going to come all the way up into new highs, but I wouldn't be very surprised to see this come up to around 2040, which is going to drag the Russell up as well, up into maybe this 1190 area or so. So that would be the most likely move I see coming forward at this point. If we take a look at the Dow, this also looks like it has more to climb, and likely turnover point here would be a little over 17,000. And of course, the NASDAQ here is the only one that I look at that has a good possibility of turning around early. So we'll have to keep an eye on that. That could drag the rest of the market down. Technically, we did break above our resistance point, but we have an awful lot of resistance in this whole area. More than likely, though, we're probably going to push up back to around 4,400, range sideways for a little while. Let this thing that happened here consolidate a little bit, and then eventually push higher. Like I said, I do think the markets are eventually going, the Russell's eventually going to 1350. The NASDAQ is eventually going up here to previous highs, unless, of course, we get an economic event like we did before that panics the market. One of the things you got to remember is the market is way overextended to the upside. Even with the down moves we've had, if you look at the longer term charts, we're still way overextended, and from that standpoint, and the participants are just going to panic as they reach for higher highs. They're going to tend to panic relatively quickly. So we just have to watch out for more of this volatility. This kind of reminds me of 2007, before the big crash here. We had an extended period of time where we had low volatility. The market's grinding upwards. Everybody's happy. And then all of a sudden in 2007, we get this big move down, takes everybody out, or a lot of people out for the month. And was a big hit for a lot of condor traders. And then the market continued to grind higher, broke new highs, kind of went sideways for a while, volatility got real low again, and then boom, you get 2008. So, I mean, I believe in patterns repeating themselves, and this to me feels a little bit like 2007. So, anyway, so that's my shorter and longer term outlook on what's likely to happen. And we'll see what happens. Like I said, I don't have a crystal ball that is actually functioning. So, this is my best guess and feeling at what's going on here. So that's what I'm thinking as far as the markets go. A lot of lessons should have been learned last week with this breakdown in the markets about trading in general and staying out of the first half an hour. And I usually recommend if you're not highly skilled at technical analysis and markets to stay out of this till 10:30 before you even do anything. And even then, generally, at certain point, I'll usually hold off till before I'll do anything as from an adjustment standpoint. That point last week, if you're wondering, I mean, I have this live M3 trade here. Let me just go back to Monday, Monday morning here. I think that's prior to any adjustments. This is a live M3 trade that I dragged up here. It's actually a $150,000 trade. So there's 30 butterflies on, and the position looks something like this Monday morning. So if we just come back to like maybe open here. Again, this was looking kind of borderline adjustment point on Friday, but there was no reason to necessarily make an adjustment if you were borderline on Friday with an M3 trade, and we're down at a support level. There's a good chance the market was going to bounce. Not unreasonable to think that you'd be perfectly fine. Like I said, unfortunately, we had news events over the weekend, and sometimes this happens, right? So we go into a free fall. Now, this technically has a maximum loss of, let's see, $15,000, which obviously was greatly, well, I don't know if it was exceeded or not, because what happens is when you hit a free fall in the market, options prices are wacko. You really have no idea what your profit and loss is. I mean, you can look at this in BackTrader and say that it's $12,000, but realistically is you don't know what your profit and loss is, because like I said, everything's just completely whacked out as far as that goes. As a matter of fact, even if you tried to do anything from 9:30 to 10, the puts didn't even have an ask. So when you look at your bid-ask spread, they didn't have an ask. In other words, you couldn't buy a put even if you wanted to, and if you did, it would be at such a high price that you'll wish you didn't. So realistically, all you can do in this situation is just hold on to your rear end and hope and wait it out. Wait till the market stabilizes and just deal with what you have when you get it. But basically, when we're in this situation, usually what's going to happen, and I like to look at the SPX for this because the SPX usually acts the most technically correct in these events, right? So when the market opened, and if we look at the SPY, you can't really see the gap in the SPX, but the market opened way down here somewhere. When the market does that, when it gaps under especially a support level and it opens up somewhere in the middle, it's going to do one of two things. The buyers are going to come in and trade it back up to the resistance level, in which case that's the point at which you buy or make your adjustments, right? Or it's going to just make a free fall to the next support level and usually exceed it. Now we could have come all the way down to 1820. I see the more major support level here at around 1880. But what it's going to do, it's going to trade down to that level, and then it's going to bounce at least half the, and this isn't every single time, this is probably 98% of the time, it's going to bounce at least half the candle. So we would have expected this market to bounce up into here. As a matter of fact, if we look at some of the shorter term charts, like maybe a 10-day chart, right, you can see the gap. We trade down to, we slightly exceed our support level, which is normal. We make a bounce, and our first real bounce was about to 1910, right? That's a real quick intermediate one. We retested, and then we bounced to about halfway between where we dropped out of our support, our resistance, our previous support into our new support. We bounced about halfway. This would be the first place where I'd be looking to adjust a trade. Generally, it wouldn't be uncommon to come up and retest the whole gap. But I'm not going to generally, especially a drop like that, I'm not going to count on the market retesting the whole gap. I'm going to count on the market going 3/4 of the way or possibly 90% of the way. I'm going to want to make some sort of an adjustment. So what I did with my position here is I left this position alone until around 12 o'clock. And I figured I was close enough to the resistance point, and the volatility had come up. As a matter of fact, if you looked at the Russell itself, pricing had lightened up enough where you could actually make some very efficient adjustments, and it worked out fairly well. If you look at my trade log here with this thing on the 24th, adjustments were done. Let's see, was that the 24th? This is right here, right? These are my adjustments, my early adjustments on the 24th. I did some later as well, but our early adjustments here were where I'd taken off most of my risk was at the 1220 level. And then later on, when the market decided to roll back down over again around 2 o'clock, 2:30, we came in here and we did the rest of the movements, because that was the most efficient time of the day to actually do anything with that, and it needed to be done. So from a live trading standpoint, that's what we're looking for. We're looking to come in here. We're looking for the normal retracement off of a move like that. And that doesn't mean that the move's over, because a lot of times what's going to happen is you're going to rebound back half this candle or maybe the whole thing. If you've traded 2008 or 2011, you saw this quite regularly and you've experienced it already. But if you're like a lot of the traders here that are kind of newer, you may have never experienced this kind of environment. But yeah, you'll bounce up to here, and then what'll happen is the market will just fall apart and come down. So you don't want to rely on the market recovering at that point. It's not 2013 where every bow move the market recovers. It's a different environment now, and you need to learn to trade it differently. I actually really, really love to trade this type of environment if the volatility happens to stay. Bearish Butterfly is a super, super trade in this environment. M3 works really well if you can stay out of the first day or so of, in other words, if you can accumulate a little bit of profit and you're not over adjusting to the upside, the M3 works very well in this environment as well. But it is a different trading environment. It needs to be traded a little bit differently than what you may have been used to if you've only been trading the last few years. All right, so a couple of questions here. I have the same feeling for the market. However, I have a super simple spread in trade right now. I'm not afraid about the bearish butterfly, but what do you think about bull put? Yeah, I was in bull puts here when the market came down into around 1880 with the SPX. I added bull puts. I don't think I would be afraid of a November bull put spread entry. October is a little close to expiration for me, but certainly in November. If you're following the bull guidelines, though, you're not. You're kind of in between trades, so you wouldn't do anything. But timing the market when it was down was the best time to do it earlier. Either Monday, Tuesday, or even Wednesday wasn't bad, but Thursday, Friday, volatility really came out. So, well, actually, the volatility didn't come out, which is something we'll be discussing at the 10 o'clock meeting. But the market's up a lot higher now. So, I don't have a problem with a bull trade. Let's see. And by the way, if you had a bullish put vertical on in the crash, yeah, you would have. In other words, if you were doing the bull trade, you would have taken a full loss on that last week for sure, right? Because we had an extreme market down move, so that would be normal. That's one of the three a year we expect. I got great fills around 11:30 a.m. on Monday. Once the right calmed down, yeah, 11:30 to 12:30 was basically, or about 1 was time to trade that. So that's good timing, Andrew. Excellent. If I'm an M3 wanting to go to a bearish butterfly, when do I dump the M3 call? That depends on what month you're in and your market opinion. So again, we plan our trades ahead of time. You should know when that point is from your personal analysis of what you think. Like I said, I think Russell could go to 1190 if your position can withhold your bearish butterfly position. If you drop a call in your bearish butterfly position from a trade planning standpoint, can withhold a move to 1210, 1220, then I would probably be interested in doing that. If it can't, then I probably wouldn't, because we're probably going at least to 1190. So that's my opinions there. But anyway, that was this trade here, which I'm not going to go over all the adjustments we did necessarily. This is not the same as the simulated trade on the website, because that's just by guidelines. This here it was entered at a different time and had different adjustments done to it. But generally, right now for a trade that is a planned capital of $150,000, we're down $651 on Tuesday, right? Looking into a position that looks like this. I ended up doing a preemptive rollback on this because, like I said, at the time we didn't know if the market was going to take off or reverse and continue down. So I did do a preemptive rollback and ended up rolling some of my position back, I think, to either 1080 or 1090. But if you look at Friday here, the position's down a little bit, but not bad, right? So we have a September M3 with $150,000 down $1,600, which is like 1%. So pretty good for considering the type of price movement that we got here on our price chart, right? So this is what I like about the trade. Very, very dynamic. Anyway, let's go back and just take a look at our simulated trades, and we will see how those are going. So I'm going to run back to, we'll take a look at a September bearish butterfly first. I really like the bearish butterfly in this environment. But one of the things I do, and one of the things we talk about is, if you ever gone any one-on-one classes with me, is basically with a bearish butterfly, particularly one that's maybe 1/3 entered or 2/3 entered, is the faster the market moves, the slower you want to react, the slower you want to be. And basically the slower or the more trending the market is, the faster you tend to want to react. So taking that, if we take a look at what our September bearish butterfly looks like, on Monday, if it did nothing till the end of the day, which is what I wouldn't, there would be absolutely no reason for me to touch this position intraday. Delta levels are good. Even at the bottom of the day here, towards the end, 46 points down. Our delta level's good. Our gain loss is good. The only issue we have is that we're past an official adjustment point. Now, I know live trading this because I have one of these on that's live. It's very close to the strike level. I did not touch this on Monday. I didn't touch it when the market came down. I didn't touch it on the bounce, and I didn't touch it at the end of the day. Really, even though I'm past my adjust point, I'm not in a whole lot of danger here. Realistically, to max loss out on this trade is impossible. First of all, to the downside, it's not possible. Second, even if I get a continued down move of another 40 points like tomorrow, I'm barely even down any money, right? No reason to freak out here or get overly anxious about it. So typically what I'm going to do is I'm going to wait for a better trading environment. And what I did both on my live trade and this one is I wait till the following day, end of day, and then I adjusted it down. Right, so we really didn't get any kind of a bounce or anything. I mean, we got some, I guess we got some of a bounce. We got a very small bounce, but just to adjust this back to the end of the day, profit levels come back quick as soon as the market stabilizes a little bit, and it's a lot friendlier adjustment. Now, with a September M3 trade, it's a different story, right? A September M3 trade has a lot of downside risk, being way back. There's really needed to adjust it intraday on Monday, but certainly a bearish butterfly, you have to take a look and balance out your risk, and really no risk there. So went ahead and left that alone, and from there were not any other adjustments here until let's see, Thursday, where we added in our second third, which I don't necessarily think that was the optimal move here necessarily, but that is the guidelines move. So let's show here. Was that Thursday? I'm sorry, that was Friday. We weren't quite to the add point here on Thursday. This is what we look like on Thursday, and this is what we look like on Friday. Right, so we add in the second third, and the position looks like this. Now, today, if we do get a down move today, we will be looking at exiting this because we're at reduced profit target territory. So realistically, if the market shoots down maybe 10, 15 points sometime during the day today, and this clearly gets up enough money to shut it out, we'll just close this down at a reduced profit target and we will move on. That's the plan for that trade. If the market does not come down or continues to move up, we are 21 days to expiration. We will be going into expiration guidelines and scaling into the 1150s and keeping our delta limit around minus 250 end of day, and allowing plus or minus 500 intraday. So we are pushing into that. And basically at this point, 21 days to expiration, I'm looking for an opportunity to exit a bearish butterfly. So that's what happened with that particular trade. Our M3 trade, I left this till the end of the day, which, you know, from a live trading standpoint, this is one of the times I probably, let me go to M3. From a live trading standpoint, I would have probably adjusted this on the bounce, right? I would have adjusted this when the market came back up into the 1130 area or wherever it came to that day. That would have been the time to actually adjust that back. But if I left this till the end of the day, still not the end of the world, down about half, a little more than half of our max loss number here. And I'm just going to come in and roll our butterflies back. So we're at 1050 now. I think I brought it to 1080, right? A little bit later in the day, the pricing actually came back a little bit. So I showed you the 1500 number. So the pricing came back a little bit. Roll this back to 1110, and we have position that looks like that. So moving forward here, Thursday, I ended up rolling it forward again. So if we come to Thursday, we are greater than 10 points past our long strike, so that's typically due for a roll up. So we rolled from 1080 to 1100. So pull this forward. We come in up into here, be 1100, and that would look something like that. And then with the continued up move on Friday, we just did 5 verticals. So if we come into Friday, we actually had a Vega issue, not a Delta issue, but we were running positive Vega. And I just did 5 of these because I don't necessarily want to go positive Delta, but I do want to get negative Vega. So I came in here, did 5 of these verticals, and now we are looking at a position that looks like that. So if we swing back and we remain range bound, which I think is certainly a possibility, this should be a good trade. If we continue up, then we're going to have some more rolls coming in during the week. But that's what we look like here. And let's see. Let me just quickly flash a T-log here, just so that you guys can kind of see what's going on for the week. We have, what else going on here? Oh, September rock trade. Yeah, so September rock trade was actually in worse shape than the M3. This was a victim of the worst timing that you can think of. We put this on Wednesday, and the market basically was in a free fall since. So, and of course we were at approximately at an adjustment point on Friday, but did nothing. So if we take a look at the rock trade, this as of, well, 1500, like I said, the pricing came back. If you didn't touch it at all during the day, which typically, again, probably around noontime, I would have been interested in doing something, but other than that, I would have left it alone. We'd be down at 1500. It was only down like $5,900. Now for an M3, that would have been a max loss. We would have taken the trade off, taken our loss, but this isn't an M3. It's a rock trade in M3 configuration. So in M3, you're not, if you're going to stay in M3 configuration, it's very unlikely you're going to pull it back from a 10+% loss. But you know, if later on in the trade it allows us to go into rock configuration, I certainly could pull this back. So, and we're not at our loss numbers, so there wasn't really a reason necessarily to exit the trade. So what we did here is just a rollback. We rolled back to 1090, and you know, now we're looking at a position that looks like this. Fairly safe position. It's just down a lot of money. So if we outrun this position, we can go into a rock position if we meet the entry test criteria for a rock position. We did not. We did get an up move, but we did not meet entry criteria. So what I'm going to do is just Thursday. We didn't roll this to 1080. I only rolled it to 1090. The reason I rolled it to 1090 instead of 1080 is because I wanted to be a little bit more aggressive. If the market were to stall, I wanted more negative volatility there. It's really, I got to bring the trade back. So I roll back a little bit less. Therefore, there was no roll up on this on Thursday, but instead, Thursday, we did 5 1090, 1100 verticals. Brought us to a position that looks like this. And essentially that's where we sat Friday. Friday, the pricing was just a little higher, but we were still in our position here. So this trade is, and I don't, oh, okay, I'm sorry. And Thursday I rolled it up. So Thursday we must have had another volatility issue. That's what happened. I just looked at my notes. Thursday we had another volatility issue. I think we were, I couldn't correct the volatility doing more verticals because I was going to go positive delta, which I did not want to do. So I ended up just rolling this from 1090 to 1110. So here is here's our T-log for that. So we just closed out the other position, rolled to 1110, put in a little bit more negative delta, and did this. So that's what we're looking at there. Again, decent looking M3 position. I'm allowing a little bit of sag here. If the market comes back, then we might actually get into a reasonable level to make money with this with an M3 position. If the market really takes off and I can make my entry test, then I can go into rock trade and maybe pull it back that way. So this could go either way. This, if we lose, it'd be the first trade for the loss for the year on this particular trade. So that is the September rock trade. That's all the September trades. From October, we have an October Bearish Butterfly, which required no adjustments. All right, that's right now. As of Friday, it was up $150. Obviously, this moved back to 1105. Did not bother this thing in the least. So no adjustments there. We had a October M3, which did get adjusted. If you look at this at 1500, Oh, here was a bearish butterfly at the bottom of the market, by the way, right? So we've got some options mispricing here, but other than that, that position looks good. Going to the M3, again, we had this never came near the maximum loss number. This time frame just has a bad tick in it. If we go to the 1500 time frame, it was down only like 2,500 bucks. So we ended up taking this. Usually, right? Usually we're due for a rollback here. We're actually right at our delta limits here. Again, the same with the bearish butterfly. Again, the September M3 had to be rolled back immediately. This October M3, I'm going to tend to leave it till the following day. I'm still it's 1060 till our max loss number, right? So almost 50 points to our real real max loss number. Like I said, the other one was just a bad tick or a bad time frame in option view. So left it here until the following day, and then adjusted it down the following day, like we did with the bearish butterfly in that date. That's how I would have live traded it. So just showing you that here. That puts us into an M3 position that looks like this. And then, let's see, on Friday, let me see if I need to do anything else here. Yeah, Friday I had to roll back up to 1110. So if we go to Friday, we had a roll in this position back up to, up to 1100. No, 1110. So we rolled this back up to 1110 on Friday due to, again, being 10 points past the long strike at the time. So this is down about half our maximum loss number. One of the things they did on Friday is they really killed us on value on our positions if you're still in the market, either both in October or November or September. So that's only temporary. They're just trying to hold us in over the weekend. Here, this is where we stand with that. And then we have an October V condor, which interestingly enough did not get bothered but in the least by this move. So if you take a look at Monday, and I'll answer a couple questions and then we'll get going here. So if you look at Monday, October V condor, we were within our delta limits. We're down about $1,000. No big deal here. The volatility, really cool thing about this trade in this type of, I mean, you get a normal down move, it gets drawn down. You get a down move with an explosive IV. The V condor usually does pretty well, especially early in the trade. So, yeah, really no issues here. We were good, and then if you move that forward, we just run into, I think we're slightly profitable at the end of the week. Yeah, so we're about break even. So so no drama there. So just a regular, sitting around doing nothing. So let's see, would I recommend doing an M3 or bearish butterfly on stocks like Amazon or Netflix? You can do M3s and bearish butterflies on stocks with the caution that you should do it small. You have a what am I trying to say? A risk when trading a stock that it might cut in half overnight, right? So we have a lot more price movement risk in a stock than we do in an index. So that being the case, you'd want to trade small and make sure it's smaller. In other words, you have a much higher probability of drastically exceeding your maximum loss in a stock. So there's nothing wrong with it. It's just you need to keep that in mind and keep yourself sized appropriately. I entered as a modified rock on the 19th. It was more resilient than the M3 configuration. Yes, it would be. You have to watch the volatility drop this morning if it happened. Volatility drop is going to kill you if you're in the front quarter of the tent, which you probably are. So you have to watch that. All right, M3 October, the increased number of butterflies, was it because of volatility? Yes. If I put one call on with 10 butterflies, I was around 0 time value or $1 time value, or 90 delta, for example, or even 80. I was way too positive delta. So we went in and added extra butterflies to balance that off. All right, so it looks like that's all we have. So I'd expect the markets to calm down a little bit this week. Before I say that, I should actually look at what the market's doing. Yeah, we're down $2. No big surprise there. So I'd expect them to calm down a little bit this week. Maybe test back here at around 1135 and continue higher. But in generally holding range, I certainly wouldn't expect new lows this week. So those are my thoughts going forward. I hope everybody has a great week trading, and we will talk to you next week.